Welcome to the research desk.
Glad to be here.
So, imagine a company so unbelievably massive that it generates nearly $3 million in revenue for every single one of its 150,000 employees. I mean, just think about that scale for a second. Now imagine that this exact same company's financial future and its frankly staggering multi-trillion-dollar valuation rests almost entirely on one seemingly simple question.
Right, the upgrade question.
Exactly. Will you, the average consumer, find a new suite of artificial intelligence features compelling enough to abandon your perfectly functional smartphone and, spend $1,200 on a new one?
It's the multi-trillion-dollar question.
It really is. Today, our analysis centers on Apple Incorporated, trading under the ticker AAPL. We're looking at the company's position as of March 2026. Apple currently commands a market capitalization of $3.71 trillion, with the share price sitting right at $252.64.
Which is a premium. A heavy premium.
A massive premium. And that brings us to the central tension we'll be exploring across today's data slides. Can Apple's premium 32 times trailing PE valuation actually survive if the highly anticipated Apple Intelligence features underwhelm the consumer market and this whole AI-driven upgrade supercycle just fails to materialize?
Yeah, if it just falls flat.
Right, so we are going to unpack this systematically. We'll move through the company's financial frameworks, examine the historical narrative cycles, decode the internal technical geometry, evaluate some structural market analogies, and finally look at the buy-side conditions that dictate portfolio weighting.
It's a packed agenda.
It is. Now, I represent the perspective that Apple is no longer a speculative technology story, it's a sovereign financial asset with a consumer electronics engine attached. I maintain that this 32 times PE multiple is entirely justified by peerless financials and unprecedented capital return machinery and an ecosystem that functions more like a luxury brand than a commodity hardware producer. So this structural durability means the multiple is insulated even if AI monetization proves to be a slow, methodical burn rather than some immediate explosion.
Well, I come at it from a different way. The data we are looking at requires a far more cautious and perhaps rigorous interpretation. We are evaluating a company positioned at stage 5 of the corporate clock.
The mature phase.
Exactly. For our listeners, the corporate clock is a classical framework where stage 5 represents the mature and harvest phase. It's the point where hypergrowth inevitably yields to sheer scale, and the focus shifts from market capture to cash extraction. Concurrently, on the market sentiment clock, Apple sits at roughly 330.
Which is post-Euphoria.
Right, entering what we define as a Phase 3 post-Euphoria consolidation, paying 32.0 times trailing earnings, 27.2 times forward earnings, and an enterprise value to revenue multiple of 8.5. For a mature, hardware-dependent business is historically perilous. It's just dangerous. This premium valuation effectively prices in a flawless, immediate AI-driven hardware supercycle. If consumer utility falls flat and the anticipated wave of device upgrades fails to materialize, this glaringly yellow valuation flag is going to trigger severe multiple compression.
You think it wipes out the whole thesis?
It would fundamentally wipe out the entire left-side accumulation thesis that so many institutional buyers are currently relying upon.
Well, let's establish our baseline positions clearly before we advance into the deeper financial frameworks on slide 1. My stance is rooted in the empirical reality of Apple's sheer scale and its proven operational durability. The fundamental metrics are just staggering. Trailing 12-month revenue stands at $435.6 billion, and that top-line figure is actually growing at 15.7% year over year.
Which is a rebound.
A massive rebound. And the free cash flow generation is an equally extraordinary $106.3 billion. The market's impatience regarding artificial intelligence, this fear that Apple is somehow falling behind faster-moving competitors, I think it represents a fundamental misunderstanding of Apple's historical operational tempo.
How so?
Well, Apple does not deploy technology like a venture-backed startup. They aren't rushing a minimum viable product to market to appease some VC board. They deploy on what I like to characterize as a luxury railroad timetable.
A luxury railroad timetable. That's a new one.
Think about it. The trains leave the station only when the tracks are perfectly laid, the ticketing is seamlessly integrated, and the platform is flawlessly branded. The current valuation reflects this structural durability and the absolute certainty of execution, not merely the impending euphoria around AI. The December 2025 quarter, which delivered a massive $143.8 billion in revenue, proves that the installed base economics remain remarkably powerful even when the headline narrative cools down.
Okay, but the core vulnerability in that perspective is the assumption of perpetual multiple preservation without corresponding transformational growth. Apple is undeniably a spectacular enterprise. I mean, no one is disputing the operational mastery required to generate those figures. But a 32 times trailing earnings multiple leaves absolutely zero room for error. Zero.
I wouldn't say zero.
Mathematically, it's virtually zero. We are discussing an industrialized behemoth generating $2.9 million per employee. That level of industrialization means the easy efficiency gains, the low-hanging fruit of supply chain optimization and margin expansion, they are entirely exhausted.
They've squeezed the stone dry.
Exactly. The entire premium we see in the stock today rests heavily on an AI narrative that has yet to definitively manifest in consumer replacement behavior. If that massive December 2025 revenue spike of $143.8 billion proves to be an anomalous pull forward, perhaps driven by early adopters who just wanted the new chip rather than the beginning of a sustained structural reacceleration, the stock is highly vulnerable.
You think it was just early adopters?
It very well could be. Mature hardware businesses simply do not sustain 32 times earnings when their growth reverts to the low single digits.
Well, we will test those exact vulnerabilities right now by unpacking the financial architecture supporting the company, specifically utilizing the Damodaran four walls framework on slide 1.
Aswat Damodaran's framework. Let's do it.
Right. So for those following along, Damodaran's framework evaluates a firm's intrinsic value based on 4 pillars: revenue growth, operating margins, capital efficiency, and valuation risk. Systematically, we need to examine the 3 walls that are flashing a vibrant green before we address that yellow valuation flag you're so concerned about.
Fair enough. Start with the green.
The first wall is revenue growth. The historical progression here decisively shatters the prevailing 2023 myth that Apple had somehow devolved into a low-growth utility. If you look at fiscal year 2023, the company saw a revenue dip to $383.3 billion, which was a 2.8% contraction.
And the market panicked.
Completely lost its mind. But observe the recovery trajectory since then. Fiscal 2024 advanced to $391.0 billion. Fiscal 2025 reached $416.2 billion, and now the trailing 12-month figure has accelerated to $435.6 billion. That represents a 15.7% year-over-year growth rate.
It's a large absolute number, sure.
To put that in perspective, adding 15.7% to a $400 billion base means Apple is organically generating the equivalent of an entirely new Fortune 100 company in new revenue every 12 months. For an enterprise valued at $3.71 trillion, that top-line expansion is just an extraordinary demonstration of ongoing franchise vitality.
I come at it from a different way when assessing that growth, though. Growth must always be evaluated alongside the price paid for that growth. Adding massive absolute dollars of revenue is a function of scale, but the percentage growth is what sustains the multiples.
But 15.7% is high for that scale.
A 15.7% bump is impressive when you're recovering from a contraction, yes. But the law of large numbers dictates a sustaining mid-teens percentage growth on a $500 billion base requires increasingly miraculous product cycles. It's not a baseline you can project forward indefinitely. But let us proceed with your margin analysis, as that is where the narrative gets particularly complex.
The complexity is exactly what makes it a green wall. The second wall is operating margins, and the data here is practically peerless in the physical hardware sector. Apple maintains gross margins of 47.3% and operating margins of 35.4%.
Which is absurd for a hardware company.
Right, we have to pause and explain the how behind those numbers because they genuinely defy traditional economic gravity. These are software-like outcomes generated on top of a highly complex, globally distributed physical supply chain. A traditional hardware maker like a Dell or an HP operates on single-digit or very low double-digit margins.
Usually around 6 to 8%.
Exactly. Apple achieves 35.4% because of total vertical integration. They design their own silicon, the A-series and M-series chips, which eliminates the margin that would traditionally go to an Intel or a Qualcomm. They exert monopsony power over component suppliers, basically buying up global supplies of advanced manufacturing capacity.
They bully the supply chain.
You say bully, I say optimize. And crucially, they blend high-margin App Store and services revenue, which operates at nearly 70% gross margin, into the hardware mix. This creates a blended operating margin that simply has no equal in consumer electronics.
I concede the mastery of the supply chain. Tim Cook's architectural design of Apple's global logistics is historic. It's a masterclass. But we must address how that cash is utilized.
Which brings us to the third green wall, capital efficiency. Apple generates $135.5 billion in operating cash flow against only $29.2 billion in capital expenditures. That delta creates the $106.3 billion in free cash flow.
A massive war chest.
Furthermore, the reported return on equity is a staggering 152%. Now, I will admit that 152% ROE is largely a capital structure artifact driven by their aggressive share repurchases, but it actively demonstrates the sheer power of this war chest economy. The company converts its net income into cash with absolute reliability and then uses that cash to perpetually shrink the outstanding share count. They are a self-funding, share-consuming machine.
Okay, that is an incredibly thorough breakdown of the 3 green walls. But I must direct our attention to the 4th wall, valuation, which is flashing a distinct, undeniable yellow.
The yellow flag, here we go.
The metrics you just outlined are undeniably elite. No one is debating Apple's quality here, but the market has fully priced them in and then some. Apple currently trades at 32.0 times trailing earnings, 42.1 times book value, and 24.2 times enterprise value to EBITDA.
Which is high, but
Let me just clarify for our listeners. Enterprise value to EBITDA strips out the debt and cash to look at the core operating profitability relative to the total cost of acquiring the business. A 24.2 multiple there is priced for absolute perfection. These multiples offer absolutely zero margin of safety in the classic Graham and Dodd sense.
Benjamin Graham was evaluating railroads and textile mills, not digital ecosystems.
The math still applies. Benjamin Graham taught that an intelligent investor must purchase an asset at a sufficient discount to its intrinsic value to allow for human error, bad luck, or changing macroeconomic conditions. You are suggesting buying a stage 5 mature company at a multiple that historically requires hypergrowth to sustain.
I disagree that it requires hypergrowth.
While 15.7% growth is impressive for its size, it does not mathematically guarantee multiple preservation in a macroeconomic environment where interest rates are decisively above zero. The valuation assumes the artificial intelligence supercycle is already a guaranteed massive success.
I see why you think that, but let me give you a different perspective on how that multiple actually functions mechanically. Because a 32 times PE for Apple does not behave like a 32 times PE for a mid-cap software company.
Math is math.
Yes, but the mechanics are different. The multiple is optically inflated but structurally sound precisely because of the capital efficiency we just discussed. Let's look at the balance sheet. Apple carries a total debt of $90.5 billion against $66.9 billion in cash, resulting in a net debt of merely $23.6 billion.
Right.
Because that net debt is trivial relative to their $106.3 billion in annual free cash flow, Apple possesses the unilateral ability to aggressively shrink the denominator. The denominator in this case is the outstanding share count, which currently sits at 14.68 billion shares.
They buy back shares, yes.
Imagine a pie representing the company's total earnings. Every single year, Apple uses its cash to buy back slices of that pie and destroy them. As long as the denominator reliably contracts, the earnings per remaining share expand, even if the absolute net income growth moderates. This continuous share retirement creates a synthetic growth rate that defends the 32 times multiple from collapsing.
I'm sorry, but I just don't buy that. Let me tell you why relying on that mechanism at this valuation is incredibly dangerous. Shrinking the denominator is financial engineering. It is not operational innovation.
It creates shareholder value regardless.
It acts as a shock absorber, certainly. It smooths out the ride. But it cannot permanently defy gravity if the core product cycle stalls. If the hardware dependency, which, let's remember, still accounts for roughly 52% of Apple's total revenue, if that begins to drag because consumers decide their current devices are perfectly adequate without the new AI features, multiple compression will outpace the rate of share repurchases.
They could just increase the buyback.
A buyback program, even one utilizing $100 billion a year, cannot mathematically offset a PE multiple contracting from 32 down to 22. If the market suddenly decides Apple is merely a highly profitable utility rather than a growth engine, the multiple will reset and the stock price will plummet regardless of how many shares they retire. You are buying a ceiling, not a floor.
Slide 2, the 5-cycle narrative history. To truly understand the market's current anxiety over this AI cycle, we have to contextualize it within Apple's historical transitions. The market has consistently underestimated Apple during transitional phases.
They have navigated transitions well, I'll admit.
We can trace this through 5 distinct narrative cycles, moving from near-death to the current reacceleration. Cycle 1 spans from the company's founding in 1976 through 1997. The critical data point here is the $150 million rescue investment by Microsoft in August 1997.
When they were basically bankrupt?
They were weeks away from bankruptcy. Surviving a 97% drawdown from its peak built the corporate DNA for methodical, ecosystem-first reinvention. It stripped away the hubris and forced a discipline that still dictates their actions today.
That was 30 years ago.
But the culture remains. Cycle 2 from 1997 to 2012 encompasses Steve Jobs' return, the launch of the iPod, and the iPhone revolution. That took revenue from a mere $19.3 billion in 2006 to $156.5 billion in 2012.
The golden era.
Then Cycle 3 from 2012 to 2020. This was the essential services pivot under Tim Cook, proving the company could monetize the installed base with iCloud, the App Store, and subscriptions post-Jobs.
The pivot everyone said Cook couldn't pull off.
Exactly. Cycle 4 from 2020 to 2024 was the massive COVID hardware surge that drove the valuation past $3 trillion as remote work forced global device upgrades. And now we are in Cycle 5 from 2024 to the present. We are currently witnessing the transition from what the market initially perceived as AI underwhelm to an undeniable fundamental reacceleration, culminating in that $143.8 billion December 2025 quarter.
Characterizing Cycle 5 as a definitive structural reacceleration based on a single blowout quarter is incredibly premature. We need to be precise about what happened in 2024 and 2025.
The numbers don't lie.
But the context matters. The initial AI underwhelm was not merely a psychological misunderstanding by an impatient Wall Street. It was rooted in material product reality. When competitors were launching highly visible, transformative generative AI models that could write code and create photorealistic video, Apple Intelligence launched as a staged, private, highly constrained on-device rollout.
Because they prioritize privacy.
Regardless of the reason, it fundamentally failed to create an immediate spectacle or drive instantaneous hardware upgrades. Furthermore, relying on the corporate ghost of the 1997 turnaround is a false comfort in 2026. Back then, Apple was a desperate underdog innovating for pure survival. They had nothing to lose by upending the status quo.
And today,
as we noted, they are an industrialized behemoth. They are the ultimate incumbent. The risk of structural stagnation is acute. If the specific utility features of Apple Intelligence, such as deep system summarization, advanced image handling, and proactive workflow automation, if those fail to drive sustained double-digit iPhone upgrades throughout fiscal 2026, the historical comparison to the iPod or the early iPhone will completely evaporate.
But the historical parallel is not about desperation. It's about methodology. Apple's delayed, highly controlled artificial intelligence rollouts mirrors their exact historical approach to MP3 players with the iPod or smartphones with the initial iPhone.
You're saying they're playing the long game?
They always play the long game. They do not invent the underlying technology. They never have. They wait. They observe the friction points and the user experience failures in early competitor iterations, and then they execute an invisible integration followed by highly visible monetization.
Invisible integration?
Yes. The market panicked in 2024 because Apple Intelligence did not look like a flashy standalone chatbot. But Apple did something much more profound. They treated AI as a foundational platform layer. They made it battery aware. They integrated it deeply into developer application programming interfaces. They ensured it was globally supportable and privacy compliant.
The luxury railroad timetable again.
Exactly. That is the luxury railroad timetable in action. The resulting $143.8 billion December 2025 revenue figure proves that this methodical integration is actively working to retain the user base and stimulate upgrades on their own schedule, not the market's arbitrary timeline.
Retaining the user base is not the same as driving a supercycle. I agree that their ecosystem lock-in is unparalleled. If you have an iPhone, a Mac, an Apple Watch, and your entire family uses iMessage, you are not switching to Android just because Google has a slightly better photo editing AI.
Never. It's too much friction.
Right. But retention merely justifies a 20 times multiple. A massive, high-margin supercycle is what justifies the current 32 times multiple. That is the vulnerability. If consumers upgrade their phones in 4 years instead of 3 years because the AI features are perceived as just nice to have rather than essential, the revenue growth rate collapses and the multiple compresses.
Well, to see if the market actually shares your anxiety about that supercycle stalling, we need to move to slide 3 and examine the internal market mechanisms supporting the stock right now.
The quantitative data?
Yes. We must decode the internal technical geometry underlying the current 252.64 share price. For our listeners who may not engage with quantitative momentum models daily, we are looking at the mathematical derivatives of price action to understand the deep institutional sentiment that isn't obvious on a standard stock chart.
It's under the hood.
Exactly. The geometric order profile for Apple is highly nuanced but definitively constructive. Let's look at the metrics here. The anchor order is 0. The volatility sigma, which measures the dispersion of returns, is a very manageable 0.27.
Low volatility.
Very low. The slope is negative 0.3463. However, the acceleration is positive 0.455. And the jerk, which in physics and quantitative finance is the rate of change of acceleration, is a powerful positive 1.321.
You're putting a lot of weight on the jerk metric.
Because it shows the turn. The specific analogy derived from this quantitative data is that Apple is currently behaving like a heavy aircraft or a supertanker leaving a storm. The negative slope reflects the 11.6% residual retreat from the 285.92 all-time high. It shows the historical backward drift.
The hangover from the peak.
Right. However, the positive acceleration and the highly positive jerk indicate that the rudder has fundamentally turned. The downward drift has lost its mathematical force, and the internal momentum is dynamically shifting upward. The big money is shifting its posture.
That's an interesting point, though I would frame it differently. Overinterpreting internal geometry at this specific juncture is incredibly dangerous. You are extrapolating a bullish macroeconomic thesis from a trend signal that is not fully open.
It doesn't need to be fully open to be valid.
Let's look at the practical reality of the chart, not just the third derivatives of momentum. The stock sits at 252.64, which is merely 2.9% above its 200-day moving average of 245.58.
2.9% is still above.
The 200-day moving average is the ultimate dividing line between a bull market and a bear market for institutional investors. A 2.9% cushion is an incredibly thin margin. It is razor thin. If the upcoming quarters reveal that hardware dependency is indeed stalling because the consumer utility of Apple Intelligence is perceived as weak, that negative slope you mentioned will compound rapidly.
But the acceleration?
A macro shock, a softer than expected guide for China sales, or a weak earnings print will easily overwhelm the positive jerk you are citing. It'll drag the price cleanly below the 200-day moving average and invalidate the technical setup entirely. It will trigger automated selling programs.
I'm not convinced by that line of reasoning because waiting for a perfectly positive slope and a fully open trend confirmation means mathematically missing the optimal entry point for institutional accumulation. We really have to discuss the concept of left-side accumulation.
The U-shape theory.
Right. For our audience, imagine a stock chart forming a U-shape. The left side is the downtrend finding its bottom, the right side is the confirmed uptrend. If you wait until the right side is obvious to everyone, the premium is already gone.
But the risk is lower on the right side.
Sure, but the extreme score metric we track sits at a very moderate 7 out of 20. This indicates that retail sentiment has normalized. We are entirely avoiding the blow-off top risk that characterizes highly speculative tech assets. The left-side accumulation thesis is defended precisely because the trend is not yet obvious to the retail participant.
So it's a smart money play.
Institutions are building multi-billion-dollar positions here based on the positive second and third derivatives, the acceleration and jerk, anticipating the slope turning definitively positive as the AI monetization becomes universally apparent in the late 2026 earnings reports. They are buying the turn before the ship is visibly heading north.
Building positions ahead of the data is inherently speculative, which fundamentally contradicts your opening premise that Apple is a safe, sovereign-level asset. Sovereign assets do not require front-running an unproven consumer hardware supercycle to justify their valuation.
The safety is not derived from speculation. It is derived from historical precedent regarding installed base transitions. And that brings us to slide 4, our first major structural analogy. Microsoft from 2013 to 2016.
A classic transition study.
Let's set the scene for a moment. In 2013, Microsoft under Steve Ballmer was viewed as a culturally familiar giant whose best days of Windows and Office dominance were assumed to be entirely behind it. The market treated them as a mature cash cow with absolutely no narrative future. They were missing the mobile revolution entirely.
People thought they were dinosaurs.
Exactly. The parallel to Apple today is exact. Apple's old myth is the pure hardware iPhone revolution. Its current challenge is proving to a highly skeptical Wall Street that the new services and artificial intelligence monetization layer is equally durable.
And you think Tim Cook is doing what Satya Nadella did?
I do. When Satya Nadella took over Microsoft and initiated the shift from selling shrink-wrap software licenses to recurring Azure Cloud and Office 365 subscriptions, the market was highly skeptical. But patient investors who recognized that Microsoft was simply transitioning its massive installed base to a new delivery model were rewarded exponentially. Apple is currently executing the exact same installed base transition. They are moving from pure hardware dependency to an AI-enhanced services annuity. They have 2 billion active devices. That is the installed base they're monetizing.
I accept the structural similarity regarding the underlying mechanics of an installed base transition. It is a valid historical comparison in terms of corporate strategy. But I fundamentally attack the valuation disparity in your analogy.
The multiples were different, yes?
Very different. In 2013, Microsoft was trading at a massive discount. It was widely considered dead money by Wall Street. It traded at a PE multiple in the low teens. That severe discount provided an immense runway for multiple expansion once the cloud transition became evident. As the market realized the cloud transition was working, the earnings grew and the multiple expanded simultaneously, creating a massive compounding effect for the stock price.
But Apple doesn't need the multiple to expand from here.
But Apple is already trading at a 32 times PE. To illustrate the sheer scale difference, Microsoft in 2018, well into its successful transition, generated $110.4 billion in revenue and $32.3 billion in operating cash flow. Apple today is at $435.6 billion in revenue and $135.5 billion in operating cash flow.
Which just proves they are a much stronger asset.
It proves Apple is significantly more mature and far more harvest-oriented than Microsoft was at the beginning of its transition. The market has already priced Apple for a perfectly successful AI transition. There is almost no asymmetric upside at 32 times earnings. If they pull off the AI supercycle perfectly, the multiple might stay at 32. There is only severe asymmetric downside if they fail to execute.
That's a compelling argument. But have you considered that you are applying the wrong comparative framework entirely? Comparing Apple to Microsoft or to traditional technology hardware companies limits our understanding of why the market happily pays a premium.
What's the right framework then?
We need to move to slide 5 and shift our lens to the LVMH luxury ecosystem comparison. LVMH is the conglomerate run by Bernard Arnault that owns Louis Vuitton, Dior, and Tiffany. The reason Apple commands and sustains a 32 times multiple is that its products behave economically more like luxury Veblen goods than commodity consumer electronics.
Veblen goods. Items where demand increases as price increases.
Right, because the price itself signals status and exclusivity. Consider the margin disparity we discussed earlier. Apple maintains 35.4% operating margins. By contrast, look at Samsung Electronics following their Galaxy smartphone peak in 2013. Their operating margins hovered around 16%.
Because Samsung sells commodities.
Exactly. Why the difference? Because Apple is not just selling silicone, aluminum, and glass. They extract 3 distinct types of rent simultaneously: brand rent, silicon rent, and distribution rent. Think about the social dynamic of the green versus blue text bubbles in iMessage.
The blue bubble effect.
That is not a technology feature, that is a digital velvet rope. It is social exclusion. Consumers don't buy an iPhone Pro for the raw processing teraflops. They buy it because it is the socially mandated premium device. Therefore, the 32 times multiple should be analyzed as a luxury brand multiple, structurally immune to the standard cyclical compressions of the tech hardware sector. It is a digital Rolex.
I come at it from a different way. That is a seductive narrative, but we must explore the inherent limits and severe vulnerabilities of the luxury comparison. The economic drivers are fundamentally different. LVMH customers are purchasing heritage, exclusivity, and artificial scarcity.
Apple has a heritage now.
But not artificial scarcity. They are buying a handbag that was hand-stitched and deliberately underproduced. Apple customers are purchasing utility, connectivity, and technological integration at a mass scale of hundreds of millions of units a year. Furthermore, and this is the critical distinction, luxury brands do not face existential regulatory threats to their distribution models.
The regulatory risk is overblown.
Is it? If regulatory pressures in the European Union, via the Digital Markets Act, or the United States Department of Justice, force Apple to fully open the App Store to third-party payment processors and alternative marketplaces, the distribution rent you highlighted collapses.
They've managed it so far.
The European Union is demanding Apple open its NFC chip to alternative digital wallets and allow sideloading of applications. Regulators do not launch aggressive antitrust actions to dismantle Louis Vuitton's flagship boutiques on the Champs-Élysées, but they are actively attempting to dismantle Apple's digital storefront. You simply cannot assign a bulletproof premium luxury multiple to a high-margin revenue stream that is being actively targeted by coordinated global regulators.
Look, the regulatory friction is absolutely a known variable, and it shouldn't be dismissed. I'll grant you that. However, Apple's historical ability to navigate, delay, and mitigate antitrust mandates without sacrificing aggregate ecosystem revenue is exceptionally well documented. Even when alternatives are legally mandated, consumer inertia heavily favors the native Apple architecture.
People are lazy, essentially.
Or they prefer security. Users simply trust Apple's integrated payment systems over third-party alternatives. This operational resilience against external shocks brings us to our final analytical phase on slide 6, evaluating the final buy conditions and establishing what would actually break this left-side accumulation thesis.
Let's see the scorecard.
We operate on a rigorous 6-condition framework. Based on the data we have unpacked today, 5 of the 6 essential buy conditions are currently met. First, we have elite quality, evidenced by the margins and cash generation. Second, we have pristine balance sheet strength, with only $23.6 billion in net debt against massive cash flows.
Agreed on both.
Third, we have highly adequate growth at 15.7% year-over-year. Fourth, we have normalized sentiment with a 7 out of 20 extreme score, meaning retail exuberance is checked. And fifth, we have profound strategic durability, driven by the luxury-like ecosystem lock-in.
And the 6th?
Is the fully open trend confirmation on the technical charts. Consequently, deploying a 2 to 3% portfolio weight into Apple via left-side accumulation is both mathematically sound and historically validated. It positions capital ahead of the inevitable realization of the AI monetization curve.
Well, my analysis must focus entirely on the thesis breakers, because as I have maintained throughout this discussion, at 32 times earnings, the margin for error is functionally non-existent. A 2% to 3% portfolio weight might seem prudent, but we must define the exact conditions that require abandoning the position.
What are your breakers?
There are 4 specific sequential events that would fundamentally break this left-side accumulation strategy and force a revaluation of the equity. First, if trailing revenue growth decelerates from the current 15.7% back down to the low single digits, perhaps due to a macroeconomic slowdown in China, while the PE ratio stubbornly remains near 30, the risk-reward profile deteriorates immediately. You are overpaying for stagnation.
Fair. What's the second?
Second, if operating margins crack below the low 30s, this could easily occur due to the massive multi-billion-dollar capital expenditures required to build out edge AI infrastructure and secure proprietary server capacity, especially if there is no corresponding immediate software monetization payoff to offset those costs.
I think the vertical integration protects the margins, but okay. Third,
The structural impairment of App Store economics via the regulatory actions we just debated. If courts force Apple to forfeit its 30% take rate, a massive pillar of its high-margin services revenue evaporates. And fourth, the ultimate catalyst. If Apple Intelligence fails to materially influence consumer upgrade behavior over the next 12 to 18 months.
The supercycle question again.
Yes, if users look at the new device and decide that summarizing text messages, rewriting emails, and generating custom emojis is a mere novelty rather than an essential daily utility that demands a hardware upgrade, the yellow valuation wall will exact a severe toll on the equity price.
We have reached a critical point of analytical convergence regarding valuation sensitivity. We both agree that valuation serves as the definitive fulcrum for Apple's near-term equity performance. The framework demands precision, and your thesis breakers are valid stress tests. Given the absence of a traditional Benjamin Graham margin of safety, any localized execution miss, whether tied to softer macroeconomic conditions in China, increasing regulatory friction in Europe, or even a slight delay in the global rollout of the next Apple Intelligence feature set, could trigger a disproportionately sharp reaction in the stock price.
Because it's priced for perfection.
Right, the market is priced for perfection, so imperfection will be penalized. However, the counterweight to that sensitivity remains the undeniable reality of $106.3 billion in free cash flow. That cash operates as an internal market maker, continuously absorbing volatility through relentless share retirement. Every dip is met with institutional and corporate buying pressure.
The share retirement creates a floor, undoubtedly. It provides liquidity and constant demand. But a floor at a $200 share price is very different from a floor at a $250 share price. The crux of the debate remains whether an industrialized giant operating at this unprecedented scale can engineer a massive supercycle purely through iterative software updates when the physical hardware form factor remains fundamentally static.
The hardware hasn't changed much, it's true.
Objectively answer whether the AI narrative translates into systemic revenue generation or if it is merely the latest tech buzzword failing to move the needle for the average consumer.
To summarize the respective positions derived from today's extensive analysis, the perspective I hold maintains that Apple's peerless fundamentals, extreme capital efficiency, and actively improving internal technical geometry make it a highly secure left-side accumulation asset. It is uniquely positioned to navigate the artificial intelligence platform shift with the exact same methodical, ecosystem-first success that defined its historical navigation of the mobile internet transition. It is a luxury ecosystem that monetizes patience.
And my summary emphasizes that the current 32 times price-to-earnings multiple leaves absolutely no room for operational missteps, regulatory defeats, or narrative disappointment. If Apple Intelligence ultimately proves to be an engaging novelty rather than an indispensable daily utility that forces hardware upgrades, the yellow valuation wall will violently compress the multiple, exposing the left-side accumulation thesis to significant capital risk.
Both perspectives acknowledge that the company's capital allocation frameworks and historical resilience are elite. The enduring disagreement rests entirely on whether the current $252.64 share price adequately discounts the structural risks of a potentially stalled hardware cycle and regulatory headwinds. The definitive indicator will not be found in press releases, but will emerge from the hard consumer replacement data aggregated over the next 12 to 18 months. This is the research desk officially signing off.